Well, good morning, everyone, and welcome to the Fiber Broadband Association's Five for Breakfast. We're now on our 21st episode of 2024. Before we kick off, I'd like to thank Wesco, the platinum sponsor of Five for Breakfast. And congratulations to the District of Columbia, Delaware, Pennsylvania, and Washington on the approvals of their initial proposals for the BEAD program. That brings this total of 8 states and territories that now have been approved. So we have 48 left for NTIA to approve. This latest round of approval is another critical opportunity for fiber broadband, the most reliable, high-performance technology to deliver broadband services to connect communities to powerful broadband applications and opportunities for success. Last week, NTIA Assistant Secretary Alan Davidson testified before the House Communications and Technology Subcommittee. When asked if he'll relax the fiber preference, he said that they, NTIA, are confident that their approach to technology is consistent with the statute. And other topics addressed included the need for the Affordability Connectivity Program to be funded, as ACP goes hand in hand with BEAD, and there are opportunities to streamline permitting. Additionally, the topic of rate regulation came up, and Davidson reaffirmed that NTIA is not engaged in rate regulation and is faithful to the statute. There are grant conditions that broadband providers have to meet, which one is to obey the low-cost option the state puts in place. Some states has chosen to put in place lots of different approaches, such as ranges and prices, but NTIA does not believe that this is rate regulation because they are not setting a price. On Friday, the House released their version of the Farm Bill. This is the beginning of a process that will last through the summer. FBA will engage on the relevant broadband programs included in both the House and Senate versions of the bills. The Fiber Broadband Association's next regional Fiber Connect workshop will be held in Deer Valley, Park City, Utah, which is coming up very quickly on Tuesday, June 4th. So Deer Valley, just an amazing place in June, and I hope that you guys can join us. You're not going to want to miss that. In addition to Deer Valley, we'll be in Des Moines in September, Calgary in October, Albuquerque in November, and then of course the big granddaddy of them all, Fiber Connect 2024, with over 4,000 to 5,000 people, will be in Nashville, July 28th to 31st. That brings us today's Five for Breakfast session with Peter Supino, the Managing Director and Lead Analyst for Telecom and Cable at Wolfe Research, who's going to be discussing fiber primer, growth utility, or pipe dream. Before I formally introduce today's guest, I'd like to introduce David Norris from our team, who will walk us through some housekeeping items.
Thank you, Gary, and good morning to everyone who's joined us today. Before I go over a couple of logistics, we'd like to once again thank our platinum sponsor, Fiber for Breakfast, Wesco. Now, please keep in mind all participants are in listen-only mode today. To ask a question, please type it into the question box located within the control panel on the side of your screen. We will have a Q&A session with our panelists today at the end of the session. This presentation is being recorded and will be available on FBA's website within 24 to 48 hours. And you can find that recording in the Events tab under the Fiber for Breakfast drop-down option. Finally, at the conclusion of today's presentation, you'll be prompted to complete a brief feedback survey. Please take a moment to do so. We appreciate your input. And with that, I will pass things back over to Gary. Thank you very much.
Thanks, David. Yeah, I'm so used to saying Trish Ehlers. Sorry about that. So good morning. I'm Gary Bolton, the President and CEO of the Fiber Broadband Association. Last week on Fiber for Breakfast, our guests were Sachin Gupta with CenturyNet and Jordan Gross with Lumen, who chair our Fiber Broadband Association's Middle Mile and Public Policy Working Groups. Their topic was, let's meet in the middle. 42 million last mile connections are a dream without rural middle mile. So if you miss it, I encourage you to watch the replay on our website. And if you'd like to join the Fiber Broadband Association's Middle Mile Working Group, please reach out to Jennifer Vassil, the Director of Membership. She is at jvassil, V-A-S-S-I-L, at fiberbroadband.org. Today, our guest is Peter Supino. He's the Managing Director and Lead Analyst at Telecom and Cable at Wolfe Research, who's going to be discussing fiber primer, growth utility, or pipe dream. Peter's been an equity analyst at Wolfe Research for 3 years, and prior to joining Wolfe, he was at Sanford C. Bernstein, a subsidiary of Alliance Bernstein, where he was the managing director covering telecom and cable sector. He's also spent 14 years on the buy side as a sector portfolio manager and director of research at Passport Capital and White's Investments. And Peter also began his career at Allen & Company after graduating from Williams College, where he received a BA in history and was the quarterback of the football team. Welcome, Peter. And for our audience, please type in your questions to go. With that, I'll turn it over to Peter and get things started.
Thanks, Gary, and thank you all for joining. It's an honor to be speaking to you today. I'll offer up a quick background on our firm because we're actually new to covering cable and telecom, relatively speaking. So many Wall Street firms go back decades. Wolfe Research was founded in 2008 in the wake of Bear Stearns' collapse by Ed Wolfe, who was the #1 ranked transports analyst at Bear Stearns. He created Wolfe from scratch with about 10 people. Today, we are, I think, quite supportably the top independent research firm on Wall Street. We have about 290 people, over 25 senior analysts covering various sectors of U.S. equities. And the teams are robust. Devin Briscoe of my team is on with us today. Had a massive role in the creation of the report that you'll see some excerpts from. Our team of 5 covers 24 stocks across cable, telecom, media, and entertainment. And as Gary alluded to, telecom has been a thread in my career, which goes back 24 years now. I've been fortunate that the sell side equity portion of my career has been spent at fine independent firms like Bernstein and Wolfe, and gives us the latitude to produce work like you'll see a bit of today. With that said, if you would please just advance to the next slide. So here you can see, well, actually, let me start by just framing the reason we wrote this report. Public markets investors are constantly worried in telecom about marginal return on capital. And the publicly traded telecom companies are building billions of dollars of fiber annually, as many of you are either participating in that effort or doing it in parallel in private structures. And the investors are first and foremost worried about whether AT&T, Verizon, Frontier, and others are earning returns in excess of their cost of capital on these builds. And so that was really the primary public market demand for this work. It turns out it led us in many directions, talking with people at private companies building fiber, consultants, public companies, and this 60 exhibit report pieces all that together. You'll just see a handful of those exhibits today. So with that kind of purpose statement in mind, here's a look at fiber homes passed, excluding cable and rural builds in recent years and forecast. And the key takeaway is that despite macro headwinds from inflation of labor and capital, and also elevated competition from FWA, which surprised many people on Wall Street and in industry, fiber expansion barely decelerated in 2023. And it looks on track to us through 2025. Why is that? First, broadband pricing looks very robust. Stepping back, why did fiber expansion become such a robust trend? 10 years ago, it was nowhere. Some of you may have been building privately, but 10 years ago, the consensus on Wall Street, and it was supported by the big 3 telcos, was that it was very tough to earn returns on capital expanding fiber. And yet today, the pace is robust and pretty linear. We think the reason is first and foremost broadband pricing. I remember when I was bought my first cable internet connection, I think I had 25 megabits per second for $30 a month. Today I buy 10 or 20 times the speed at 2 or 3 times the price. And that broadband ARPU growth, to a significant extent on a local level, leveraged some fixed costs of PP&E and distribution. And today the opportunity to sell into that market is much more profitable than it was 20, even 10 years ago. And so with that in mind, we see the now or never mentality, given the importance of being first to connect a home with fiber. So both public and private companies' agendas are to meet a high demand for alternatives to cable and for converged relationships. In our survey work, about 60% of consumers want to buy a converged product. And of course, private companies are looking at participating in what should and likely will be an eventual consolidation of the fiber space. So lots more to say there, but that's why we think this trend continues. Let's go to the next slide, please. Slide 3 shares our vision for fiber's heading. The key numbers here are that fiber homes passed are expanding from 59 to 95 in context of US occupied homes, expanding from 130 million to 140 million. This slide includes assumptions about where that growth comes from across suburban, urban, small markets, new homes, and deep rural. For example, we think there are about 20 million, maybe 25 suburban and urban homes today that are not passed by a native fiber connection. We think many of those will be passed, but not all, for reasons of poverty and income and affordability and neighborhood topography. We make similar TAM limitation assumptions across these 4 different types of growth. Let's go to the next slide. Slide 4 shows a long view, which we call steady state for fiber. We see today's 22 million fiber subs growing to 40 million before any benefit from BEAD subsidized passings, which could add another 5 million and create fiber subscription of 45 million over the long run. Perhaps this is the mid 2030s. Probably not lost on many of you, at $70 per month, that's a $38 billion annual revenue pie. And with a 50% EBITDA margin, which we think is supportable given what some mature broadband only businesses have shown, the EBITDA pool for fiber could reach 14 billion annually. On slide 5, if you'd move on, our forecast assumes that AT&T, Verizon, and Frontier continue to lead the market, with AT&T widening its gap to Verizon because it's spending much more aggressively, building at about 4 times the rate that Verizon is. We think AT&T has the right strategy, and we think that T-Mobile's appetite to play a role in the other bucket that you see here is increasingly clear. It's worth noting competitively that not only could T-Mobile play a role in owning some of that other bucket as a consolidator, but T-Mobile can probably drive up the potential penetration of that other bucket. I think we could all readily accept that a company with 4,000 to 5,000 retail stores and a top 20 national brand in terms of the amount of money spent behind it every year on generic consumer marketing could earn higher long-term penetration than a company without those resources. And so T-Mobile's appetite to put capital to work in fiber, and potentially much more over time, because our belief is that if T-Mobile's in for a penny, they're in for a pound, means not only can they own a lot of that royal blue bucket, but that it can be bigger because of their resources. Let's go to, before we move on, I also want to flag that penetration is a really interesting topic here. Wall Street is cautious about fiber penetration, which you can see in the exhibit on the right. And that's because primarily fixed wireless was widely doubted on Wall Street a couple of years ago and has blown the doors off of consensus expectations. And today, many investors believe that today's fiber expansion plans were created before fixed wireless was understood to be such a strong local competitor. And therefore, today's penetration assumptions should be looked at with doubt, should be doubted until they are revised to reflect FWA with a 15% national market share. The other reason why Wall Street is skeptical about fiber penetration is the low churn rates that cable companies report in regard to their own broadband subs. So in the context of that skepticism, it's interesting to see that AT&T and Frontier's penetration rates on mature fiber vintages are well north of 40%. And Frontier is reporting that new vintages are meeting their own expectations. Why is that? I think that segmentation is often poorly appreciated by telecom investors and telecom analysts. And in reality, fiber and FWA are fairly different segments of the market. Let's go to the next slide. So here's a look at how we get to a 13% return on capital. The key assumption, which is along the heading, is that we're using a 40% long-term penetration rate. That's not as deeply penetrated. That's lower than AT&T and Frontier's mature builds. And of course, there is a very important ARPU assumption in here, which you can see rises towards the 80s over time. It's a 3% annual growth rate. I won't drag you through all these numbers. Those of you who are so inclined are welcome to follow up with us. But it's the way that a long-term owner of these assets should probably be looking at the value of what they're creating. Let's go to the next slide. So industry structure globally is the number one explanatory variable of broadband pricing, of telecom industry margins and over time. And so we make our forecasts for fiber with a very intense focus on industry structure. Today, broadband is still a monopoly for about a third of American households. Of course, how you treat fixed wireless, which is everywhere and nowhere, from a capacity perspective, is a squishy portion of that calculation. But certainly, in high capacity gigabit speed broadband is a monopoly for about half the country, and a duopoly elsewhere. And we think that's the reason why, in the exhibit on the right, broadband ARPU has continued to grow at nice rates despite historically elevated, unprecedented levels of broadband competition. We believe that broadband ARPU will continue to drift higher because ultimately there are one or two places to get the premium version of the product. And if you're a price sensitive customer, you have a few more options from fixed wireless. But we remind our clients that there are 130 million homes, 120 million broadband homes in the country. And the telcos are the first to acknowledge that their FWA capacity is limited in the best case scenario to less than 20% of those homes. And so really the incumbent broadband providers know that FWA just can't handle the stock of broadband subs. It can have a big effect on the flow of broadband subs, but the stock on which pricing is taken every year can't all flock to FWA. Let's go to the last slide, please. So in context of high penetration assumptions and pricing grinding higher over time, we see a big equity valuation opportunity for people building fiber assets. As you can see in this slide, we've circled the enterprise value to EBITDA multiples at which telecom and cable assets trade. In reality, they're even lower than what you see for wireless telecom because AT&T and Verizon trade for much lower multiples than T-Mobile. However, companies with attributes like fiber broadband, and we've detailed a bunch of them here, long duration, high EBITDA margin, moderate growth, trade for 2, sometimes 3 times the multiple that traditional U.S. incumbent telecom companies trade for. And we think that the argument for fiber to sustain much higher multiples is really robust and getting stronger. First of all, as fiber businesses mature, there's a good history of evidence that their multiples, that their margins expand, and higher margins would tend to be good for multiples. And secondly, we think that fiber companies need to be appreciated as being less capital intensive and unencumbered by declining legacy businesses in comparison to the incumbent telecoms and cable companies. So that is our presentation for today. I know we have a bit of time for Q&A, and I'd be happy to hear yours and respond as well as I can.
Peter, this is awesome stuff. Really interesting. Let's start with, how accretive fiber is. So we saw, things like when Frontier sold off a lot of their properties to Brightspeed and so forth, that seemed to be very, very accretive. We're also seeing a lot of the tier twos, kind of the regional operators. So whether it's Alta Fiber or Frontier and Windstream and so forth, they're putting a lot of investment to fiber. So does Wall Street really view this investment in fiber as being very accretive?
I think Wall Street, defined as the public equity markets, is cautious on whether fiber is an accretive use of capital. Wall Street agrees with AT&T and Verizon's assertion that it makes sense for them to build fiber, but that's less a conviction about the ROIC than it is a strategic view that those companies are stronger with more fiber assets over time. It's a high capacity, low cost form of a network with a pretty good industry structure. And so without any transparency for the public markets on whether those companies really are earning returns, they get the benefit of the doubt, and Wall Street gives a green light. But Frontier, the publicly traded company, is a really interesting bellwether for investor confidence in returns on fiber builds. And while the stock is up a lot over the last year for reasons we could go into, it still trades at a much lower multiple than the aspirational benchmarks on that slide we just showed you. And I can tell you anecdotally, there are many short positions on Wall Street in Frontier based on the view that first, based on the view that since Frontier's business plan and long-term guidance was inked, labor and capital are much more expensive and fixed wireless is much bigger than anyone imagined. And so how could Frontier possibly meet the long-term expectations it set years ago when those things have changed since then? So summary, lots of skepticism.
Well, so let's get into, you mentioned cable is pretty good at retention. That's not what I'm seeing. Up till like 2022, the net subscriber adds on cable, they were just gaining market share and market share and market share. And then all of a sudden, as fiber started getting deployed, now they are negative net sub adds. But they seem to be doing a fantastic job on ARPU, better than the telcos. And what our industry analysts are saying is there's no ceiling on ARPU. I mean, people pay more for their broadband and TV services, and sometimes they pay for rent or mortgage. I mean, it's crazy.
You are spot on about the poor subscriber growth at cable. What the cable companies tell us, and of course they don't report the numbers so we can't know for sure, is that their problem is sales rather than elevated customer losses. And as many of you operating networks can appreciate, the subscriber net add number is a function of how many subs you get and how many subs you lose. And we're talking about millions of gross adds, millions of units of churn, and just a few 100,000 net adds or losses. So small changes in those big numbers produce magnified changes in net additions. And so again, best information we have is that cable's problem is that when customers are new in the market, when they're out looking for service for various reasons, whether they moved or they're upset with their provider, that they are less often choosing cable and more often choosing alternatives.
All right, so one of the audience questions come in is, do you think the push COVID gave broadband is now being accelerated by potential for AR, VR, and AI and machine learning, or is it being driven more by the federal funding programs?
So the consumption of data in American households continues to grow at high rates, as reported by all of the publicly traded reporting broadband providers. Interestingly, mobile data consumption has slowed somewhat. And we also monitor consumption in European countries where in certain cases, mobile data consumption has slowed into the teens as a growth rate, down from 20s and 30s previously. And so there really isn't evidence that AR, VR, or other new data intensive applications like 4K TV have caused accelerated consumption growth, but consumption is certainly still growing.
And One of the audience questions here is that you showed that electric utilities is a key vertical. We look at the ones you track as basically about 65% of the fiber market, the big tier ones, tier twos, but the rest, kind of the fastest growing segment is those rural electric co-ops. There's 900 of those. There's over 250 now doing broadband. Is that a segment that you're looking at?
It's an important segment on a local level. I always say telecom is always and forever a local business controlled by big companies with regional and national footprints. And so if I were operating a fiber business or a cable business locally, I'd be extremely interested in what electric utilities are doing. The aggregate numbers still aren't huge and not big enough to move the needle for many of the public companies we cover.
All right, so one of the questions came in is that, cable had dominant market share in broadband, so they can only go down. Big telcos now are, going for 40, 60% to take market share. Where is there room for an overbuilder or even an open access overbuilder? That would be Gigapower, right? Is open? That's a big open access overbuilder.
Typically the rational market structure is two high capacity wireline providers, presumably cable and fiber, with FWA reaching the market in a more capital efficient, less robust way. There are, of course, instances like RCN of cable overbuilds of existing cable, in some cases triopoly wireline markets. I and many in my business are extremely skeptical of the returns on those projects and do not expect to see a lot of capital invested in third to market fixed connections. But one possible justification for more of that type of investment is Gigapower, and perhaps something that T-Mobile will do in the future. And the reason is because multiple companies, and in this case, big telcos who have uniquely strong sales resources, can sell the capacity. And so if I were one position to worry about would be that of an independent fiber operator who for some reason is targeted with a Gigapower overbuild, because I'm in a position suddenly where I've got less retail distribution power than the new to market overbuild and the incumbent cable company. And frankly, investors in the public markets are worried about whether Gigapower's multi-tenant model will spread, given the potential for high penetration and for mitigating the capital requirements of all of its tenants.
Well, I'm going to have Bill Hogue, the CEO of Gigapower, on Fiber Breakfast in about 2 weeks, so we'll find out from them. Anyway, Peter, I could talk to you all day. This is fascinating stuff. I'd love to talk about how fixed wireless is a bubble and all that, but we're out of time. So thank you so much. Really appreciate your insights and research. And I hope everybody gets back together with us next Wednesday. We're going to have my good friend Jeff Hainan, the Vice President of Research for Deloro. And he does a lot of work on the cable market and going to show us how cable is moving quickly to fiber. So thanks, everyone. Peter, really appreciate it. Enjoy Michigan, and we'll see you soon.
Thanks, Gary.